Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to pay off 10 credit cards with this one simple trick. So that's my clickbait game, or me showing off my clickbait game. Hopefully, I'm leveling up. But what's that one simple trick? I'm sorry, I don't even know why I'm laughing. It's velocity banking, right? So in this example, again, I think credit cards, like huge credit card debts, is the easiest example to show how to do velocity banking. And we have an example here on this spreadsheet of someone who has 10 credit card debts. Now, I know what you're thinking, right? You see this $125,000 income, which is about $7,000 a month net. And it's like, how are you paycheck to paycheck or broke, making more than six figures? And to be honest, like before I started this channel, that six figure paycheck to paycheck person was like a unicorn to me, right? I never met anybody like that, or at least I never met anybody who admitted being in that situation. But there are many people out there who have emailed me about your situations, how you make great money, and then you just can't control the spending or have cash flow management problems. And because of that, you're interested in doing velocity banking, right? I even heard stories about some dude over like the grapevine who was a plastic surgeon making over $500,000 a year, and then he had to pack his own lunch. Again, I don't mean to laugh. I don't know why I'm laughing. It's just coming out of me. But again, this situation is quite common. And here's the thing, our debts are always proportional to our incomes, right? There's that thing called DTI, debt to income ratio. So the more money you make, sometimes we just got more debt. But I would say that uh, once you get a certain point, more money ain't gonna help you. And the reason why that is because let's say this turns to like $8,000, right? Then this will magically turn into like $7,670, right? So I don't know if you ever heard of Parkinson's law, okay? But Parkinson's law just says of money says the more money you make, the more you just magically spend, and that's what happens with a lot of six-figure earners, right? I remember when I first learned about velocity banking, I was just like kind of angry hearing about all these six-figure people being broke, and like I'm only making $20,000 a year, and only have a $500 credit card, and I'm sad, right? But not a laughing matter, but there are a lot of people like this. So again, here in this example, we're just going to learn how to pay off 10 credit cards using velocity banking. And I think this is, if I recall this correctly, is about $111,000 of credit card debt, which is huge, right? Which is a lot. Okay. Now, let's just first go over the basics of velocity banking. What is velocity banking? All it is a debt strategy to pay off your debts using lines of credit. So, what's a line of credit? All it is a financial tool where you can borrow money, pay it back, use it over and over again. Credit cards fit in that category. Personal lines, home equity lines of credit fit in that category. A little bit of differences between credit cards and regular lines of credit. Now, here's the thing. This guy's a homeowner, right? This person's a homeowner, and we'll just assume for whatever reason, let's say they refinanced, they had $200,000 of a loan, but maybe they have like $350,000 is of their home value is $350,000. I'm sorry, let me say that again. So if you don't know how home equity lines of credit works, basically the bank or a credit union will lend you or let you borrow um, up to a certain percentage of your home equity. And if you don't know what home equity is, all it is the purchase price of your home minus all the debts that you have tied to your home. So, for example, if you have a $300,000 home, right? $300,000 home, and you have a $200,000 loan, you got about $100,000 in equity, right? And then they'll lend you about 80% of that equity, which is about $80,000. So think of it as like a credit card tied to the value of your home. Okay. So me personally, I have how much in equity? I think over $300,000 in equity. Like if I were to sell my home, I think I'd have either 300 or $250,000. But here's the thing: I'm not going to sell my home. I'm just going to use the equity as so that I can get a home equity line of credit so I can manage my cash flow, right? And be able to easily pay off my debts, okay? And I don't know if I said in this video, but um, paying off credit cards with Velocity Banking is like the easiest thing. It's almost like a no-brainer. Other things you have to do, like when you have like, five credit cards and three loans, you kind of have to think a little bit. But in this example, it's so simple that all we have to do is just transfer debt to a line of credit. Okay, so let's just assume that we're gonna have this exact same income, right? Exact same income. And here's the thing: before I actually even get into this, let me go over the two requirements for doing velocity banking. So number one is the budget. So you can see we already did that. Income, $125,000 a year. It's about 7K net a month. We only have $329 in savings left over. And then the expenses, once you have that, you just want to make sure you have an expense breakdown. And you also want to make sure, I'm sorry, you also want to make sure that every single debt that you have is its own line item. Because once we either pay off or transfer debt, that's just more cash flow for us. Okay. So let's go ahead, and now we've done our budget, so we're kind of halfway done it. Now we need to do requirement number two, which is to select our line of credit as our main operating account. So what's the difference between the average American and the Velocity Banker? The only difference is that the average American uses their checking account to pay their bills, right? So checking account, and then they pay all of their bills with that checking account. Now, velocity banking is we're going to use our line of credit as our main operating account. Okay. And so what we're going to do is, again, we don't assume that we're making more money, although making more money is fantastic. You know, because here's the thing. Let's say like we have a $1,200 mortgage. What if instead of paying all that focus on a $200,000 mortgage, we just simply make $1,200, right? It's almost like kind of getting rid of your mortgage, but not really. Okay. But I'll just leave that for another discussion. Okay. So now we need a line of credit. So we'll say that we're a homeowner, we get a mortgage, but we have plenty of equity, right? Maybe our home value has shot up so high that, you know, we can borrow so much to use for our own purposes for our home equity line of credit. So think of this as a credit card based on your home value, right? And usually, if you're unless you're in the introductory rate or period, sometimes the introductory period they give you like 0.99%. I know I've experienced this before because I've had two home equity lines of credit where they had like an intro period. I think the first one was like 12 months at 0.99%, and then another one like 6 months at 0.99% or something like that. And then a limit, well, let's just make it up. I mean, do you want to just do 100,000, 50,000, 150,000? I don't know. I mean, we make good income, so I'm assuming that the banks, let's say that, and here's the thing about like borrowing money, right? You only borrow money when you don't need it, if that makes sense. You ever hear that before? So here's the thing. I have over 400, not 400, $220,000 in lines of credit, or $240,000 in lines of credit. And the way that I got it is because I knew, and this was taught to me by a credit instructor. Again, I'm not giving you any credit advice, that the easiest way to get credit from a bank is actually apply for it when you don't need it, right? Because banks don't lend you money when you don't need it. So let's assume that we got this home equity line of credit, and we had a ton of equity, but we just never used it for some reason, right? And again, if we've never used it, okay, now's the perfect time to use it. Because sometimes what happens is that we get a home equity line of credit, and because we hear things on like the media, like Susie Orman, Dave Ramsey, we get scared to use it, and we don't know what it's for. Because Dave Ramsey hates home equity lines of credit. Now, do I disagree with Dave Ramsey and his approach? Absolutely not. I love Dave Ramsey, right? I'm not going to put like a thumbnail about me versus Dave Ramsey about how he's wrong, because here's the thing: he's much more successful than I am. I mean, my understanding, he's got 50 million cash in the bank because he has no debt, and he's got a ton of real estate. So who might argue with him that his approach doesn't work? But this is a velocity banking video, so we're just going to show how we can do velocity banking. And here's the thing: the reason that, even though I'm a big fan of Dave, that I use debt tools, because Dave always says like when he talks about like paying off debt, beans and rice and beans, I ain't gonna do that. You know what I'm saying? So I prefer to pay off my debts without really changing my lifestyle. So let's just assume that we have $150,000 in 150, $111,000 in credit card debt, right? 111, okay? And then, and actually, let's go ahead and calculate this. So $5,000 plus 15,000 plus, and we're just going to add these up just to make sure that I'm not crazy. 30,000 plus 20,000 plus 15,000 plus 7,000 plus 5,000 plus 500 plus 2,500 plus 11. 2,500 plus 11,000 Yeah, 111,000, right? Okay, so what happens when we do the debt transfer of these 10 credit cards to that home equity line of credit? Okay, we'll take a look at this, right? Every debt that's transferred to the home equity line of credit, the payment goes to zero, right? Zero, 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 zero. Oh my goodness. And how much cash flow do we have now? And the other thing too, take a look at this. When we do velocity banking, the savings are going to be zero because what we're going to do, and I haven't explained the strategy yet, at least in this video, is we're going to put our entire paycheck into this line of credit, take out our expenses, and then rinse and repeat over and over again. Okay? So when we put our entire paycheck in, what are the two things that happen? One, we satisfy the minimum monthly payment, so the minimum monthly payment doesn't really matter. And number two, we minimize the interest because we're dumping our entire paycheck in, and we're not going to have as much interest than if we're just making just minimum payments, which is really what the banks want, right? What they want you to do is they want you to have your home equity line of credit as credit card number 11 and then use like your extra savings just to pay the minimum payment. And they call this phenomenon segregation of income, but I'll talk about that in another video. Okay, so now let's do this. We did this one simple trick of doing a debt transfer to the home equity line of credit, and again, for some of you, this might not be a realistic scenario. I get it because you might think I will never make six figures because oh my goodness, OMG. And then you see articles nowadays about how six figures isn't enough because of inflation, blah 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 blah. So again, it all depends where you're at in life. There's once upon a time I was making 20 grand a year, and I still learned about this. And then when the time was right, when the iron was hot, or I forgot what the actual phrase is, when it was time to strike, then I did it, right? So maybe you're at a point where you're making $20,000 a year and you think, man, I want to do velocity banking. Well, there's two problems in life, right? There's the income problem, there's a cash management, cash flow problem. And if you're at that income problem, don't learn about velocity banking, but realize you're not at the stage where you can apply it. That's really what I want to emphasize. Some people get so confused about like when it's appropriate and they want to just apply velocity banking when they're not making enough money to a point where banks would even lend them a line of credit or even just debt in general, right? Because this is a debt removal strategy. It's not an income generation strategy. It's a cash flow management strategy, and we're using it to remove our debts. But let's just do this. Take a look at this. We went from $330 to 3,800, right? Just by simply doing a debt transfer. Okay. And here's the thing. We're gonna figure out what the uh, hold on, what the next month's balance will be. So G2 plus H2 minus our cash flow. So that's 3,800. So where do we get that? That's this number right here. Okay. So that's our cash flow, right? And even though month one, we don't have any interest, right? We still include it, or month zero, I'm sorry. We still include it for the first calculation. So the interest doesn't accrue until you get the first statement. That's month one. And then we're going to go ahead and calculate the interest of month one, which is going to be the average daily balance. So go ahead and copy this formula right here. Point one, that's 10%, this interest rate, and then you got to divide by 12. Okay. And so uh, we have all we have to do, and actually let me take all of this, is just copy and paste until this becomes red. Red means it's paid off. And if you don't know what I mean, I'm just going to paste it right now. And you can just kind of see that paycheck in, expenses out, paycheck in, expenses out. And then we're using the full cash flow that we have to pay this all down. And by month 34, so let me just take a look here. Month 34, we paid this sucker off. So this should be zero, right? So now it took us about 30 more 4 months to pay off 111K. So let's just write that down. That's our milestone. 111K. Okay. In how many months? Oh, I have such a bad memory and it's late at night. 34 months. 34 months. And then I'm going to do this right here and right there. And equals 34 divided by 12. So 2.83 years. So not bad. It's $111,000 of credit card debt at these insane interest rates, right? And so if you're moving all this debt to a lower interest line of credit, definite win. Even if you don't do velocity banking, at least you know your the interest isn't going to grow. But the whole point of velocity banking is just using your entire cash flow to pull down your debt. And then the next one would essentially be the mortgage. So the way that the mortgage works is because, hold on, I forgot to put this 6%. So 6%. Because the mortgage is actually what you call an efficient loan, if you don't know what I mean by that, it just means, think about this. I have to pay $200,000 just to get 1,200 back. That's very little monthly payment compared to the loan amount, right? This is why you tackle this one last. And there's actually formulas that we have to kind of go over which ones to tackle over. I won't go over this now, but at this point, once you paid it off, you could just do this two things: put your entire cash flow directly to the loan, right? And then just pay it off with extra payments, or you could just still do velocity banking where you transfer, let's say, an amount compared to, let's say, your salary to the line of credit and then pay it off using your cash flow. Now, what's the difference between this one and this one? Well, if you pay it directly to the loan, right, then you'll save a lot of money, right? Definitely. And you'll, same here, you'll save a lot of money. The only difference is that if you put it in a line of credit, yes, you'll be charged some interest for doing that. But here's the thing. The reason why most six-figure people are broke is because of a phenomenon called segregation of income. And this is something I talk about with any six-figure person, that they're broke. Your paycheck comes in your checking account, you pay, like, your income is split in like 10, 12 different places. And because you're essentially making minimum payments in every single debt that you have, and it's split up into different places, that is why you're broke, right? And the easiest way to prevent this is to make sure that your money is all parked in one place. And I know this is kind of abstract, but let me just show you how you would do this with velocity banking just really quickly. So let's say, and actually, let me just do this. Sorry. Let me, okay. So let's say at this point, you wanted to transfer maybe $7,000. So that would be 193, okay? And you want to just pay that off quickly. Just transfer $7,000 right here, right? 7,000. And I'm actually going to highlight this to see when we did a transfer. And then you'll see in 2 months right here, it got paid off, right? And then you could just do another transfer there, another $7,000, but you're still making payments to the mortgage. So you're actually going to pay it off faster than what I write here, at least, right? Oh, I'm sorry, because we're assuming we're making principal payments. But again, I want to make this an easy example of just paying off 10 credit cards because that's what the clickbait thumbnail title said. But yeah, see how easy it was? Again, some of you might be thinking, oh my goodness, this is like the craziest thing because who's going to lend me a $150,000 line of credit? And my answer to that is it depends on what stage of life you're at, right? Because, when I learned this, making only 20K a year, nobody was going to lend me money for a mortgage, right? No, no one's going to lend me a 10K credit card. And now at this stage of life, just because I just studied it over and over again and practiced the basics and learned what the banks want, I have over $240,000 in lines of credit. 240. And once upon a time, if you talk to me, I could only get like maybe like a $5,000 credit card at the most. And if somebody offered me a 10K credit card, I would have my mind blown, right? So just want to throw that out there. Okay, well, this is Korean Atlanta Mentorship. So 10 credit cards with this quote, one simple trick. It only took us about 34 months, and 34 months, let me just calculate that again, is about 2.83 years, so almost 83, I'm sorry, not 83, almost 3 years. But what about you? Do you have over an insane amount of credit card debt? How are you doing? Right now, this year, um, I should be able to pay off more than $50,000 of debt. So last year I paid about $58,000 of mortgage. This year I had some credit card debt and I paid about $50,000 off. So again, this scenario could be realistic for you because it's kind of what I'm doing right now with my life. All right, so it's Korean Atlanta Mentorship, everybody. If you're interested in joining our group, go ahead and click the Google form link below. Other than that, have a great day and we will speak next time.